Hello everybody, welcome back to another episode of the Investor Motivation podcast. You are with Rob and Amy again.
G'day, how you going?
Great, how are you?
Good, Friday afternoon. Been a good week.
Yeah, hitting close to 4 o'clock, so we've got an hour to go, and that means we're in great moods for podcasting. Not that we're not in good moods always.
Happy to.
We love what we do.
Yep, happy to have a chat about what we do, and we should do a podcast on some of our case studies that we're seeing at the moment, which would be really interesting. I think, we've a lot of stuff we have spoken about is debt and leading into retirement, and debt is often associated with investment properties and so on, and that's a real handbrake for families at the moment, and retiring with big lumpy illiquid assets with debt on it just doesn't work. No,
but you're right, that would be probably the biggest common, I guess, new initial appointments is people with lots of investment properties and they're wanting to liquidate those slowly, and how to do that in the most tax effective way, which is great conversations.
Where people have had some great capital gains, that's got to be dealt with, and it can be dealt with.
Yep, absolutely.
Fantastic. What are we chatting about today?
Today we are going to be talking about small cap stocks and what the risks of those are.
Awesome. So that's a cool topic. And I've got some experience in this one.
Yeah.
Because I have invested into small caps.
I've dabbled.
You've dabbled, and mostly positive or mostly negative for you?
Well, this idea actually came from my partner, and I said, what's a good podcast that you're interested in? He said, what are small cap stocks? And it's because I'm up in this one small cap that we're both invested in, but he's down. So I've just bought in a different time, and So I'm good, he's bad.
Okay, and I suppose psychologically you can just feel fantastic about it. You're the king investor in the world, and
absolutely.
And Cody's not. And I've got quite a lot of experience in that area. And I remember it was Marcus Padley. I think he was a stockbroker in Melbourne, but could write a very good article, and he wrote an article about where some of the big gains come from. And there was a quote within there. It spoke about trying to find that rocket under a rock.
Yeah.
And I've kept that. I've got it somewhere. I've got that article somewhere. But it's talking about trying to find that that small business that just that one in 1,000 or whatever is that shoots the lights out. And it's just an absolute game changer.
Yeah.
But the path that led me down was probably not the right path. But we'll cover that off in a sec, because it gets down to there's small caps in some sectors which are less risk than small caps in other sectors.
Yeah, that's correct.
So there's, like anything, there's markets within markets, there's different sectors, and probably I've definitely had some small cap success, but I've had some small cap immense pain.
Yeah.
Which are what I always say to my clients. I've learned those lessons, taken that pain on your behalf.
Yeah. Yeah. And like there's small caps that do well and small caps that do bad. There's the same with any stock, really, that there are large businesses that can go down 80% or lose it all as well. So
less likely in a more mature business, of course.
Yeah.
But we'll cover off, I suppose, what makes them more risky than a more mature business.
Yeah.
It'll be profit, of course.
All right, before we crack on for too long, on behalf of the Investor Motivation podcast, we would like to pay our respects to the traditional owners of the land on which we are recording this podcast, and pay our respects to the elders past, present and emerging.
Cool. Thanks, Amy. I'm happy for you to kick off with obviously some of the risks. I think we've got to, for a balanced discussion, talk about some of the upside. But what are some of the risks?
Well, some of the risks, and like I just said, I might be up at the moment and Cody might be down at the moment, but the volatility of the small cap space means tomorrow I might be down just as much, or volatility is really extreme, because generally these companies aren't actually profitable yet, and that's why they are such small, lowly valued companies. So expect massive swings, even if there are no announcements, or because generally with those bigger businesses, if there is large swings in the charts, there's an announcement to coincide with that.
Yes.
But these smaller ones are just very, I guess, consumer sentiment oriented as well.
Mm-hmm. So less impact from the bigger fund managers. Would not be analysing these companies. If they thought it was a good idea, but it had a market cap of $100 million, and they're running a fund worth $2 billion, it's just they can't get they wouldn't be able to really take a position in such a small business.
No.
It would, yeah. If they did, it would probably move that business far too much.
Yes.
And have little impact to their fund.
Yeah, exactly
So
right.
they're not widely
not
widely researched.
Yeah.
Yep. So sort of saying perhaps that volatility could be that you have the non-professional investors, perhaps the people that are looking for the rocket under a rock.
Yeah.
Yeah.
A little bit more of the guessing game, and because they are such small companies, I guess when you do even go onto the analyst websites or wherever you go to look at the finances and all the different ratios,
Yes.
sometimes you can't actually get all of the ratios because there hasn't been a single analyst to analyse that business. It might be so small.
Yep. And let's define what a small cap is. So in my mind, it's anywhere from probably $20 million, which there are businesses that small on the Aussie Stock Exchange, all the way up to sort of 2, 3, 400 million is still classed as a small cap. Then there's the mid cap space, where we've definitely had some good luck with our clients investing in that space, but also had some ones where it didn't go our way.
Yeah.
But the ones that did well did exceedingly well, and the ones that didn't do quite as well, they're a bit just, we'll call it mid.
Yep.
Down that 30 or 40%. So it doesn't break a portfolio, but the ones that have done well have outshone, so far.
Yeah.
So obviously just higher levels of volatility.
Yep.
Yep. And when we mean volatility, that volatility can be down in share price, but it can also be up as well.
Absolutely.
Yep. Now, liquidity risk.
Yeah, so because the fund is, like I said, generally unprofitable, they can't really build their cash reserves and also there isn't always a buyer willing to buy that business when you're willing to sell it, because that is the share market. There needs to be a buyer for every sale. So if it's small cap and not well marketed or...
Yep, it's just not big enough for anyone to be interested.
No one's going to find these little tiny businesses that you might be looking at.
So this is all about trading volumes, the ability to get in, to buy, and then once you're in, can you get out if you wanted to? And I've probably learned a very big lesson where I took too big a position in a very small cap, which was around that 15, 20 mil.
Small.
Yeah, very small. I couldn't get out if I wanted to.
Yeah.
And that position still sits there today in a substantial loss position. Yeah.
And I guess it's not only the share market needing a buyer to buy your shares you want to sell, but also liquidity within the business itself. If it isn't profitable, the chance of it going belly up is obviously higher than a business that's profitable.
Yeah, you need cash.
Yeah.
Yep, cash flow, revenue, and I suppose this is where obviously there's markets within markets, different sectors. The area that I just know to avoid, because I've taken the pain on behalf of my clients, is that the small cap exploration sector where they're drilling to hopefully find something.
Yeah, pick a random spot in the dirt and hopefully something good turns up.
Yeah, that's right. And I think that's where, I don't know what the numbers are on these businesses. If you get the right one, well, look out. It can help people retire early if they choose.
Yeah.
But they're just, it's drill and hope.
Yeah.
A lot of optimism. And that, essentially means that they're spending money and there is zero money coming because they're trying to find a resource.
Yeah.
But if they do find a resource, to get that to a mine is such a huge step as well.
Yeah.
Huge step.
And they need a lot of money to be able to do that step.
Yeah, and I think it's worth kicking on to the discussion around if you've got a business that's drilling or just reinvesting heavily and it's not profitable with very little revenues or no revenues like a exploration business.
Yeah.
What are the companies going to do for their shareholders? What they're going to come back with their
share purchase plan.
Yeah, they're going to come with their hand out to say, we'd like some more money, please.
Yeah, you've given us a little bit, but we'd like you to double down so that we can try. Especially if it's one of those drilling out of the ground that might have come up short. We want to try again somewhere else. This is our plan of where we're going to drill. Give us some more money to do it.
Correct. Yep. So with a share purchase plan, many years ago it was $15,000 for a share purchase plan was the maximum. Yep. So the reason why they do that, there was a whole regulatory, I suppose, process they need to go through, a legal process. If they keep it under 15, now it's $30,000, and that can mean that they don't need to go through this big process, and they can raise capital relatively easily.
Yeah.
So it's 30 grand. They will often provide new shares at a discount to the current share price as incentive for current shareholders to do it. It is often underwritten, so it means if us as retail shareholders don't take up the shares, then the institutions will take up what we don't.
Yeah.
So now there is a downside if you say, "Oh, gee, I don't have the cash to do this." That that we've got 100 million shares on issue, and then they're issuing another 100 million shares.
Yeah.
And if you don't participate, you've just lost. In percentage terms, you own 50% less than what you did prior.
Yeah. If you owned 1% of that business, you now own 0.5%.
Correct. And that's called dilution. That there's X amount of shares on issue if you don't participate. So you really want to be a believer in some of these small cap businesses.
Absolutely.
Particularly, now there are small cap businesses that can also be profitable.
Yeah, that's right. And hopefully they all become profitable. That's the game of all of their business plans. If you can find a business that is profitable already, that's obviously less risky than one that isn't.
Yeah, small businesses can be very high quality and very profitable.
Yep.
This is a very small business. It's never going to come up on the radar of any stock market anywhere.
No.
But it's still a great, small, profitable little business that we've ran for the last 26 years.
Yep.
So, I'm not scared off by investing into small businesses, but they just get sometimes too low. You go back to that, share liquidity issue.
Yeah.
Hard to get in, exceedingly hard to get out when you want to.
Yeah.
Cool.
And with that, just for a bit of balance here, if you were wanting to dabble into the small cap space, I would suggest only putting in what you're willing to lose.
Yeah,
really.
And that might be, 4 or 5% of a whole portfolio.
Yeah.
But as I said, putting some money into this area is a good thing to do. And quite often a lot of these small caps have a lot of, the founders own a lot of these businesses.
Yes.
So this is not the risk. This is one of the benefits, that you're putting your money beside the people that started it, that found it, and own a lot of it.
Yeah.
There's a fair bit of there's a conflict of interest. They've got a vested interest to do well for themselves and their family and their egos. So that can be a good thing.
Absolutely, and that's something to look for any business on the stock exchange, small, medium, large.
Yes.
But that's massive.
Now, Amy, you mentioned lack of analyst coverage.
Yes.
In layman's terms, what does lack of analyst coverage mean?
So if you are someone that would just jump onto Yahoo Finance, for example, you can type in the business name, any business, and generally they will have analyst coverage. So there will be, a team of analysts. It'll tell you how many, so it might be 16 different analysts, and they will tell you their recommendation or how they feel about the business.
And that's where we're looking at. It can be a strong buy, a hold, a sell, or a strong sell.
Yep.
And they often give us a price.
What they think fair value is.
Correct. And what Yahoo and the people using the data, they'll collate this. They'll add it all up and divide it by the amount of analysts are there to give an average price across all those different analysts.
Yep.
But the smaller the business, the less interested they are.
Yep, absolutely. If you're looking at the big businesses like Microsoft or something, they might have, up to 100 analysts there.
Yep.
And small Aussie businesses might have 0 or at 1 or 2.
Correct. And that often happens. There's definitely some, for those smaller exploration businesses, there are often, some smaller boutique stockbroking firms in Perth that will have an opinion on an area that they know particularly well. Yeah. There's just not the depth of information.
No.
So I see that as a very much a risk and a negative, that it's hard to know what people think of the businesses.
And the bigger the business, probably the more social pressure and investor pressure for them to be as transparent and produce heaps of announcements and have a lot of information available. And of course there are regulations in place that, minimum reporting requirements for every business.
Yes.
But the larger businesses will have more information publicly available than those smaller businesses.
Yep.
Purely because they don't have those pressures as much.
And I think when it comes to how the market feels about these business market sentiment, which is one of the areas that you've sort of said we should chat about that, and I've seen price action where people just get so excited about an idea or a concept or an announcement, and people are so optimistic or greedy that it just goes through the roof, and then it doesn't pan out, and it can retract very quickly, or a report that underwhelms. Share markets are impatient and greedy. They want it all straight away. And it takes years to build businesses. So that's part of that volatility I suppose the market is after quick results.
Yeah.
We want to see the share price go only one way. So that's definitely that market sentiment, how people feel about the business.
Yeah, and that's when you do see those businesses that will bubble up. Like, I know GameStop happened because of other reasons to begin with, but then when someone's on the bandwagon, the valuation of that business grows because there's so many investors in there, and that sentiment drives that valuation up. And then there's the bubble, and that bubble has to pop eventually if it's not backed by proper, profitability and revenue for the business.
Yeah. All right. What's another risk we need to think about, Amy?
We did touch on it a little bit, but the higher risk of business failure, and especially true in those businesses that don't have, I guess, a tailwind behind them. So like we said, there are markets within markets. And I think at the moment, probably the biggest thing up and coming is this AI space and semiconductor manufacturing or battery powering and everything towards, I guess, a greener future.
Yes.
And so many small cap businesses are popping up in that space. But they do need a lot of capital funding. So there's going to be a lot of businesses in that space that do fail. And again, like you said, it's just trying to find that rock under a rock. Whatever it is you said.
A rocket under a rock.
Rocket under a rock.
Yeah. So finding I think the right sector is what you're saying there. And this is where you might invest heavily into an exploration business, and they might find something. But to go from being a company looking for something to a company producing something is such a huge leap.
Yes.
So that's where there's risks.
And I guess, again, in that space with the resources, because we are cutting back, on resources moving forward as we become greener as an economy, that's riskier than if you were to try and go into a business with a future tailwind, for example.
Yep. Now, one here we've got concentration risk, and that's probably looking at smaller businesses start off with a idea, a product.
Yes, a single product, and if that single product doesn't hit, that's the business done.
Yeah. Or if it does hit and does particularly well for a number of years, but then you have competition coming in that just makes something a little bit better.
Yeah.
And I think of Nanosonics, which has the Trophon product that they use to sterilise ultrasound equipment that they use for the ladies. So a really important device, but it's a very niche-y product.
Yeah.
They're making that product better, but it's hit some tailwinds of late.
Yeah, and they've probably tried, I guess, a little bit too hard to focus on making that single product better rather than expanding that economic moat and having 2 separate products that do separate things.
Yeah.
So it is, I guess making sure your company, even though it might start off with one thing, as they grow, hopefully they can expand. Otherwise it becomes, the video shop retailers that didn't do anything but videos, and then, Netflix came out and bam.
So continue to improve your main product, but branch out for related other products.
Yes.
Yeah.
Build your economic moat.
Yeah. Yep. So very good. So I think that's where, if we look at CSL, is obviously, and all businesses started small, but CSL has so many business units now, so many different products that one area can fail, but it can be propped up. But when you look at where the revenue comes in some of these big businesses, it's still, the initial core product, is still a huge part of the business.
Yeah.
So it doesn't matter what business we look at, we often see that's the case, but they're just diversified as they've got larger and reinvested. Yeah.
And similarly, in having a broad, like products or services base, you probably want to have a broad customer base, so not just, mum and dads, but if it's something that the government might be purchasing into, like the government has a, interest to fund plasma collection and science biotech research. So of course they will fund CSL as well. So it's
diversity of income, you're saying as well. Diversity of the revenue and the income that the business makes. That if we have a look at Fisher & Paykel Healthcare, a great New Zealand business that's traded on both exchanges, sell their product globally.
Yep.
ResMed, similar type business. They're pretty direct competitors. Australian business, but they sell their products globally. So there's diversification there as well. So I think that's worthwhile. And probably the last one, this relates back to lack of profitability, also means no dividends.
Yeah, and I guess you'd kind of hope if it's not profitable that it's not paying out a dividend, because that means they're going into debt to pay that dividend.
Yep.
But yeah, if income is something that you're after, I wouldn't go chasing a small cap stock.
Yes. Yep. Yeah. Very good. Now, we're not advocates to just chase high dividend yield companies at all. No. We more focus on high quality businesses rather than chasing a high. Sometimes you can get both, which is fine, but it's not something that we do any search that just focuses on a high dividend. No. Sometimes no dividend is fine when businesses, low or no dividend, where they're reinvesting heavily to make their business better, because we can definitely fund cash flow in different ways.
Yes.
Cool. Thanks, Cody, for the topic.
Yeah.
Terrific.
And he won't mind me throwing under the bus with saying that he's at a loss at that business. It's all fun and games.
Which business was it?
Oh, no, I'm not going to plug a small cap.
Cool.
I don't want to influence any listeners.
Done. If you'd like to learn more, we've got our YouTube channel, which is Investor Motivation. Check that out. There is coming up to 700 videos there. We've been doing it a while, over 12 years. Amy is on TikTok and Instagram, The Wealth Diaries. Yep. I'm on TikTok, Rob Gowdy, and on Instagram, and that's probably about it. Awesome. Thanks. Cheers.
Bye.
See you next time.